Yo, 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 good morning, good morning. Moderator, are we using the chat room? Hello, hello. Yeah, I don't think I have access to the chat room. I'm using the old one, moderator. So it says I'm streaming, so I'm going to have to just believe that that's true. So good morning. Comment allez-vous? How are you? My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. We're a boutique broker. We'd like to earn your loyalty and respect. Yes, we offer fast execution speed and low spreads and low fees, depending if you want an ECN, fixed spread, or variable spread. But we also have world-class customer service, and I work with clients every single day in the live markets, teaching you technical and fundamental analysis. Okay, Henley's in the chat room over there. So I think we're using different chat rooms now, but whatever. We'll get it figured out. So namaste. Thank you for being a client to Traders Way. Thank you to FX Street for hosting this webinar for the 142nd month in a row. That means we're coming up pretty close to year number 12. So congratulations. So like I said, give us an opportunity to earn your loyalty and respect. Visit Traders Way today, huh? It's your way, the Traders Way. The Trader Way! Boom! Oh yeah, you gotta love gold plate. Easy. Hope you don't mind the music in the background. If it's too much, just let me know. I'll turn it down. But you know, this is my job, man. I love just love what I do. So it's just fun. Let's have some more fun. Plus, trading's been so awesome lately. It's just like you gotta love it, right? But let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Right, sir? Ni hao ma! Yeah. So we have 3 hours together. 3 hour tour. So typically what I do is I go through the intro, make sure everyone's got their head screwed on straight. And we talk a little bit about non-farm payrolls coming up. Then we got the news to kind of deal with and look for trades and look for setups and all that kind of stuff. And then typically the last hour and a half, I just answer questions. I think we could generally go by that, where we can do a little more fundamental discussion or academic discussion of non-farm payrolls, which I think we should probably do. If not this month, sometime soon. Maybe on the 12-year anniversary of this webinar, maybe I can do like a true academic overview of the employment situation report. Henley, is the music in the background messing things up sound-wise for you guys? Sometimes the microphones have trouble, can't decide what to listen to. Oh, 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 oh. Look, I'm the guy from Coldplay. I named my baby Potato. All right. So we'll stick to the typical agenda. There we go. Hello, moderator. Moderator, is there a different chat room? Maybe, is the one on YouTube being used? Is it this one? Is it a different one? So please let me know. All right, just general. This goes back to the FX Bootcamp credo. You may know me from FX Bootcamp. That has obviously a military theme. Using this military theme idea, we had a credo that we would talk about almost every day. Sorry, I'm trying to see what they're up to. Yeah, that's the one we're in, moderator. Well, why don't you hit me up with the YouTube one? I mean, we should just have one chat room, huh? I don't know. Your call. So anyways, going back to this. This comes from a business planning retreat I held with myself after I decided to become a professional Forex trader. I quit my job as a venture capitalist, even though I had just been promoted to vice president of the firm. We had grown to about 300 employees. Loved my job and everything, but I quit to become a Forex trader because I love Forex. It's even better than my dream job. But then I ran into some troubles right after I started, maybe within the first 6 months. And I said, wow, what's going on, Wayne? And then I realized normally what I do when I start a business is I do business planning retreats and all this kind of stuff. So I went off and did a business planning with myself. And lots came from that. Like amazing, changed my life kind of stuff, right? But anyways, so I broke things down to its basic components. You know, what is the credo? How do I live and act as a currency trader, right? And I realized that the number one goal is capital preservation. Losing money like I was doing at that period of time, it wasn't terrible, but I was going through a bad period, right? And I realized losing money is the worst thing that could possibly happen. If I'm going through a bad period, at least I'm better off not even trading because then I'm not losing money. And we also know that if you lose 50% of your capital, you need to make 100% return just to get back to break even. So if you trade so bad that you've lost 50%, you're not likely to suddenly get 100% return. And even if you did, you'd just be back to where you were. So it's twice as difficult to make money than lose money is kind of the way I looked at it. So the number one goal is don't lose money. Because losing money is easy, making money as an amateur is difficult, right? So this whole idea in war, using the FX Bootcamp military theory, was like, you wake up in the morning and the first thing you say to yourself is, I hope I don't die today. I don't want to get shot by a sniper. I don't want to step an IED. I don't want to, all these things are just basic, inherent, has nothing to do with the military, the war, anything. It's just like, I don't want to die today, right? So that's kind of it. Don't lose money. The second one is it's your job to acquire, make pips, right? But how many pips? And how do you know you've made a lot? And all this kind of stuff. Like, what is enough? And so I broke the second point down where your job is to make these pips, acquire, capital acquisition in this case. You're out there to make some pips, but to measure it, I went kind of back to my sales days. And as a sales manager, I want to know how many calls my team is making, how many people they're actually talking to on the phone, how many presentations are scheduled, how many presentations were given, how many second presentations were given, how many contracts have been sent out, and then how many contracts have been signed, and then how many checks have been cashed, right? All these things are important, and they all have their own benchmarks. So I thought, well, I have to have something like a quota almost, right? Because if you don't make any phone calls, you're not gonna close any deals. So I thought, well, what would my quota be as a currency trader? And I realized there was a minimal acceptable performance, because we actually had a map on my sales teams, right? If you didn't hit your minimal acceptable performance, you'd get a one-on-one with me, and then if that still didn't help, I'd throw you out the window. And there was a pile of dead salesmen outside my window because they'd all, but whatever, solved that problem one way or the other. Minimal acceptable performance. It's not dials per day, it's pips per trade. So that minimal acceptable performance for a trade would be when you have the opportunity to move your stop and lock in 15 pips. Just 15. And this 15 pips isn't a target. I didn't say try to get 15 pips. It's not a scalp that I'm going for. It's that when you have an opportunity to lock in profit, you do. Or in the beginning, move your stop closer, then move your stop to break even, and then lock in a small trade, small profit. So that even if you get unlucky and your trade collapses on you, at least you made a small profit. And the rules of compound interest take care of things, right? So the way I got to 15 pips is that I looked at my actual trading and I found I could get lucky, make a bad trade, but still pick up 10 or 12 pips, right? But it's based on my own trading. I noticed that I very rarely got 15 pips. I either got 10 pips or I got 50 pips. So there was this idea where I should be looking for trades that should yield 50 pips, and then let that run to the 50 pips, but lock in the 15. So this was just based on my own personal characteristics as a trader. And then lastly, once I got that minimal acceptable performance locked in, so I moved to stop to protect 15 pips profit, let it run, baby. Let it run. Let me tell you, if you want to be successful on the long run, Y bar, on the long run, what you need to do is you have to let your winners run. You have to. Now, you can do income-based trading for a while, and in certain times of the year, it's most appropriate. But if all you're doing is picking up 10 pips here, 20 pips there, you will never last 15, 20, 30 years as a currency trader. Plus, you'll never make big money. You just won't. And I can prove that to you mathematically. You can fight me on it. You can say, Wayne, I'm a great scalper, 90% winners, blah, blah, blah. Great, great, great. Talk to me in 20 years. Because you won't be here. You'll grow old, you'll grow tired, you'll grow unlucky, you'll change, I don't know, you just won't do it. Plus, you'll just never be filthy stinking rich as well. So, prove me wrong. Hit me up at 2040 and show me how much money you made scalping. So what I say, like, I'm not against scalping. Let me comment on that. I love scalping. I love spot trading. I love swing trading. I like carry trading and position trading and all these different things. I like building portfolios. Love it all. Do it all. Just don't do one thing like scalp only. Okay? So whatever. Take a screenshot. Paradise. So the moderator says I'll post questions from YouTube over here. Why don't you just have people come here? Why don't I just go to YouTube? I don't understand why we have two rooms, but let me know. Okay. Speed, momentum, trend, volatility. Okay. Speed, I want to know the direction of the market. Okay. I want to know the direction of the market. Is the market going up or down? But more importantly, how quickly? The reason for that is, should I be aggressive or should I be conservative? So to know that, I need to know direction first, because I don't know if I mean, yes, I need to know if I'm going to be aggressive or conservative, but before that, I need to know, am I a buyer or a seller? You see what I mean? Right? Am I a buyer or am I a seller in this market? That's the first and foremost. And speed is a measure of market, by the way. Am I a buyer in this market or am I a seller in this market? So you need that. You need technical analysis for that. But then, should I be aggressive or conservative? So if I'm a bear and the market's falling quickly, I should be aggressive. If I'm a bear and the market's falling slowly, I should be conservative. That's what that's all about. But just that one subtle thing could change your career as a currency trader. Because you're not just buying, you're not just selling. Now let me change the lighting in here. Yeah, it's sunrise, so the lighting gets all weird. Paradise. Ooh, 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 ooh. All right. And then what's the trigger for actually, because, you know, looking at the 2155 EMAs only tells me if I'm a bull or a bear, and it only tells me if I should be aggressive or conservative. It hasn't put me in a trade. You understand that? So what's the trigger? When do you click the button to buy or sell? And that's what the 5/8's for, and that's a measurement of price. Why? What's this momentum idea? Well, if I'm a bear, I want to sell when not just, well, being bearish means the market's bearish. But as you probably know, even if the market is bearish, much of the time price is rising. So 5/8 is moving up in a down market, I don't trade. Simple enough, right? If the 5/8 comes up to resistance in a falling market, and then the 5/8 crosses down, now I can sell because I'm selling when price is falling in a market that's falling. And we have congruency. Whoa, don't go big word. Those are big boy words. Congruency between price and market. And that's what I'm looking for at all times. In fact, these oscillators, you see the relationship 2155.8, 835? Look at the 5/8, look at the 2155. So these things are telling me something similar to speed and momentum, right? Market and price. This shows me overbought and oversold conditions of the market. This shows me overbought and oversold conditions for price. So I'm separating market forces from price action using oscillators, the MACD and stochastics, right? The MAC and Stokes. But also EMAs are separating market forces from price action. I'm trying to line things up and have congruency so that I can be a cork in the river of Forex. I don't want to spend my life pushing water. What a futile, right? Futile thing to be doing, pushing water. Cool. All right, so look, YouTubers, click the link that the moderator of this webinar is posting. Click the link and visit our chat, because I can't see what you're doing. And it's really slow for the moderator to chat over. Just click over there. You can leave the video running, but just open up the chat so you can communicate with me, okay? Come on, it's Uncle Wayne here. You can talk to me. 3 hours, bro. Come on, click the link. Right? And feel free to ask questions. I'll respond. Oh man, I thought I fixed these. Huh. All right, little charts for some reason. Well, maybe I can do this during, I'll just do it this way. Okay, so here's your 2155. 21 is below 55. So therefore, just technically speaking, I'm a bear. Okay? And that's it. Sort of. 21 is below the 55. Technically, the market's bearish. That's it. Now, the second part is, am I aggressive or am I conservative? If price is below the 21, I'm aggressive. If we break through the 21, I'm conservative. That's it. So here I'm aggressively bearish. Here I'm conservatively bearish. Now, one interesting thing. Yes, Lester, you are in the right chat room. Good morning, Anise. What's up, Ray? Okay. So if you look here on this currency pair, the day opened 21 below the 55, which means it was bearish yesterday too. So you can imagine I'm hot to go HOTTOGO on being a bear today anyways, because I was a bear yesterday. It was sunny yesterday, probably be sunny today, right? That's kind of the idea. So if I was already ready to be a bear, I need a trigger to say, now's the time to sell. And that's what the 5.8 is. So this is the same thing, same chart, but from a perspective of the 5.8 now. So again, use your mind's eye that I talk about in my book, your mind's eye. Picture, if you will, the 21.55. You knew here that you were a bear. You already knew it. So you wake up in the morning and you're like, I want to sell. Cool. When do you sell? When do you pull the trigger? And that's this 5.8 cross here. Okay. So what do you do if the 5.8 crosses back up in a falling market? What do you do when price decides to rise in a falling market? Let's take profit. Okay. Bashir's asking me questions about 2019. Whoa, dude. Yeah, making it difficult for Uncle Wayne, huh? Yeah, let's just skip a whole year. Let's talk about next year. So anyways, you take profit here. Okay, and then you look for new opportunities at support and resistance. Okay. This is a trend. This is the 200 EMA. Generally, when we're doing non-farm payrolls type stuff or event-driven strategies, you don't run into the long-term fair market value very much because news takes us away from the fair market value or towards it. But I don't know, it's never really an issue. Now, if we were trading together all day, every day, like I do for Traders Way clients, then the 200 EMA would come into play more. By the way, let me make that clear. Visit tradersway.com, open up even a demo account, takes you 1 minute, and you can work with me every single day for about an hour and a half, free, just as a client. Live webinar, basically like this for an hour and a half every single day. You can ask me questions, I respond. I can even go look at your charts, your trade plans. I can go through all the markets. We talk technicals, we talk fundamentals, trader psychology. Hour and a half every single day. Just visit Traders Way and tradersway.com and sign up, man. I hope to see you on Monday. Okay, so fair market value. That wouldn't come into play today, but on a regular basis it would. Okay, but there's an interesting point about that 200 EMA that we'll get into some other time. Bollinger Bands I don't use as much as I used to. Maybe the market has just changed. You know, if you've been doing this for 15 years, you'd be shocked how much has changed, right? So the analogy, I guess, would be like when I first started trading as a retail Forex trader, it was kind of like the Wright brothers had just made an airplane, right? And so I went out and made my own airplane, and it's made out of balsa wood and some fabric, and I got a lawnmower attached to some homemade propellers, and you know, it was very, very crude, and the markets were different, man. They were like way different. And now everything is fast and sleek and full of technology, and you know, the world has changed a lot, and the market's changed a lot. It's just interesting. Maybe that's why I don't use Bollinger Bands as much, or maybe it's just the experience. I can see it without needing to have it drawn, but you could almost substitute these Bollinger Bands for volume. Okay, not volatility per se, volume. Because often when you see the volume as a currency trader on your charts, I'm not sure where they're getting that volume because, I mean, I guess it would be from the particular liquidity providers that your broker's using, but you wouldn't have everything. Like it wouldn't be a full snapshot of the market, just whatever the liquidity providers are providing. But every broker has different sets of liquidity providers, right? So it would never be complete. I suppose it's a reasonable facsimile thereof, but it's not truly the market volume. It's the volume provided by, I guess, that subset market before it hits the interbank, right? But when you're using Bollinger Bands, well, it would be accurate. It would be the entire market. The Bollinger Bands would be based on price action, right? Not actual volumes reported by the liquidity provider. So anyways, what I'm getting to is when they're wide apart, there's lots of trading in the interbanking system, right? All liquidity. And then when they're narrow, there's very, very, very low volume of trading. Okay, now really it's a measure of volatility, right? And that's a little bit more complicated math, but I think you could reasonably substitute the two if you wanted to. So like for here, hardly anyone's trading. Okay, so if you want to know, like, you know, if you take profit here, how do you know not to be trading in this zone? Well, the Bollinger Bands may have helped you there. Because you can tell no one else is trading, so why should you be trading? Okay, someone at YouTube says NFP is going to be better than expected according to my view. Great. First, that's a guess. That's fine. And two, good luck. Right on. Now, just off the top of my head, haven't the out of the last 6 NFPs, haven't 5 of them been misses? Not entirely sure. That's just by memory. But it's funny, like, why would it even matter? So I'm studying macroeconomics. Did you know that? I'm studying macroeconomics. I'm studying at Harvard in grad school, so it's graduate level macroeconomics. My professor is a senior economist at the Federal Reserve Bank of Boston. Also, I'm flying out in a couple of weeks to do a weekend course with a professor who also works at the New York Fed. Cool, cool beans. So, like, when you're talking about, like, oh, NFP is going to be better than expected based on my analysis, I could also show you, like, the long-run growth in both the establishment survey and the household survey. And it doesn't matter even in the slightest if we beat it or not beat it today. It doesn't matter. The long-run trend is so straight and so smooth. Everything else is just sort of almost meaningless, right? The economy is improving, and there's nothing to show us one way or the other that that's going to change, right? So like when Trump said, oh, well, since he's been president, they've added 2 million jobs. Yeah, well, that's the trend. You could have put a, you could have put a teddy bear in the presidency, in the White House. A teddy bear, a Tickle Me Elmo, and you still would have got 2 million jobs. Like, you could have stood on your hands and got 2 million. That's the trend. And so it's like the long-term trend in the actual reporting of how these statistics are gathered. The ups and downs, it all smooths out. It doesn't matter, right? So to the person at YouTube that is guessing we're going to have better than expected, great. I hope that helps you in your short-term trade and your scalp, and it goes your way. But that also may backfire on you, because you might find a beat on non-farm payrolls might make the market say, hey, well, Jay Powell the new head of the Fed, who's going to lead the next meeting, is not only going to jack up interest rates, which he's going to, but he could come out hawkish and just say, look at the non-farm payrolls. We're beating it. So we should jack up rates faster. And that probably, if the market makes these connections, the market might behave exactly the opposite as you think. And you'll say, look, I'm right. Non-farm payrolls is way better than expected, and then lose money. Because then the market is going to flip on that and say, well, that's bad for something else. And so that's why I like to step out and not look at a micro view, but a macro view. So whatever. We're fine. We're on trend. You know, don't worry about it, is what I would say. Don't worry about it. Don't forget about it. Just don't worry about it. So if we beat it, great. If we don't beat it, doesn't matter. We're on trend. We've been on trend since like 2010. Okay? And you can do this like, maybe we'll do this later. We could go to the St. Louis Fed and build a chart based on Fed data. We can pull it up. I'll just show you the trend, not the chart trend in non-farm payrolls, but we could say the trend in the establishment survey and just look at it, and it's just a straight line with almost no wiggle at all for years and years and years and years and years and years. So do you guys understand the difference between the household and the establishment? I mean, we can pull that up as well if need be. So maybe we'll go into the news trade, the scalp setup a little closer to the release. Shaw asked about the 5A cross back up in the downtrend. That would be a take profit. It doesn't have to be, because you can say as long as the 21 is below the 55, you're going to remain bearish, and your stop would be just above the 55, and you could try to let it run from there. Okay, you could totally do it that way. All right, YouTubers, click the link, visit the chat. You can ask questions, interact. Come on, get involved. It's down there, but join us, huh? So we got a lot. It's 8 o'clock. I mean, I wonder if we can do this. Just if I can just pull this up on the fly here. Let me pull this up. Non-farm payrolls. All employees, total non-farm payrolls, seasonally adjusted. Okay. Okay, so this is non-farm payrolls, generally speaking, since 1940. So I said since about 2010, the trend, right? So imagine in the last 7 years, how many non-farm payrolls have been better than expected, worse than expected, as expected. But when I say who cares, I mean, look at how beautiful this trade is since 2010. Okay, this gray bar here, that's the Great Recession. So that's us dropping all the way down. Okay, isn't that cool? Now I wanted to break this down though. It's hard because they have 700,000 data sets. what I wanted is the establishment survey versus the household survey. So where would I find that? Concepts, wages, salaries, hours, just employment, all employees. But this is what we had. I want an establishment survey. I don't want local stuff. See, that's the same one. So I guess I got to do establishment. Total revenue, total. Oh, this is going to get way too complicated. So this is what we did. Yeah, so this is what we had before. All right. So anyways, there's two different types of reports that go into non-farm payrolls. One of them is the establishment, which we just looked at, and that's where they're looking at payroll stubs. So it's pretty smooth. It's pretty consistent because it doesn't change that much. And the sample size is pretty reasonable. The household survey is where they actually call people on the phone. And they only survey 60,000 households or 75,000 people. And, you know, that's a little more sketchy, you know, because you never know what kind of answers you're going to get. Counting payroll stubs is just easier and more accurate. And I think the data sample is much bigger than 60. So anyways, I got one of them. I wanted to break this into two different pieces. I want to add the household to this, but I think you get the concept, right? That's non-farm payrolls since the Great Recession, right? Like, look at this. If we're better than expected or worse than expected, do you see how it just doesn't even really statistically matter? No, it's not non-farm. Non-farm says it must be a rolling average. No, that is not true. Okay? It's seasonally adjusted, but, I mean, we can even do non-seasonally adjusted. Okay? So on the aggregate, you see it's still pretty smooth. Okay? I mean, the trend is a trend, you see? But you're going to get noise in there that is not helpful or relevant per se. So you seasonally adjust it. Okay, because you get things like Christmas and all that kind of stuff in there. So going back to this, there's one blip. Did you see it? See this blip here? That's the one statistically important. What was that? That's the census. Those are census workers being hired and then laid off. Okay? So, look, if we have a beat, see, here it says 147, and we're expecting 180, right? So we'll see. We'll see. I wonder if the seasonally adjusted is significantly different. Or non-seasonally adjusted, I should say. Okay. See, you take some of this out, and it doesn't make giant differences. The difference is, you know, 46 to 48, you know, not a big deal. So it's interesting. The news release is the news release, but remember, as macro traders of foreign currencies, what we're most important with is the long-term trends. Okay? and the long-term trends, and in particular changes in central banking policies because of changes in these trends. Okay? So if we had this and we decided to put the dollar index over this, you'll see that the dollar was strong till about, what was it, 2015? So what happened was the economy shifted, and you can see that here. Okay? And the Fed changed policy. And that made the dollar strong. The economy started improving, like we got out of recession, but remember the definition of recession is that we're not growing. But at some point in here, we started growing again, right? Or at least stopped not growing. So we're out of recession, but the economy still sucked. So the Fed had policies that were still accommodative. Around here, they stopped they stopped quantitative easing. And at that point, the dollar got weak. Okay, so there's a disconnect here. There's the economic conditions that changed the policy at the Fed, but it's the change of the policy at the Fed that changes the value of the currency, not just the economic cycle that we're in. Okay, this is an economic down cycle. This is an economic boom. And this is where rich people got super rich and poor people just stayed poor, because they didn't participate in any of this. So it sucks to be poor, let me tell you. Why would you want to be poor? Some will say it's because you're happier. Yeah, I wish I was happier. All right, so there we are. Look at that. I actually drew a chart using Fed data for you. Boom. Okay. So we got 15 minutes until the news. I'm going to turn Coldplay down a bit. Okay. All right. Let's go through the scalp. How do you participate? What? I'm not sure if I follow you, Lester. Lester's like, how do I participate? I don't know what you mean, Lester. All right, so let's just move on.com. The news is going to come out. Okay. I'm looking at a couple of things. I'm looking at the direction the market is responding to the news. Remember, don't say, oh, good number, this will make the dollar do something, or bad number, and that will make the dollar do something. Don't think that way. The market can interpret it. And very often, and I've been around long enough, I've seen this a million times, where good news is bad and bad news is good. Oh, Lester wants to be rich. Well, blood, sweat, and tears for years is the most prudent way. You have to have a big brain, and you have to have brawn. So if you take your Forex trading slow, and you do not try to cut corners. You don't try to use EEAs to do your job for you. You try not to have, I don't know, other people form your opinions like, oh, I saw a guy on TV and he said I should be bullish or I should be. No, when you do your own homework, when you read the economic reports yourself, when you're on central banking websites on the weekend, reading their reports, when you hang out at the IMF and the World Bank and all these things, when you're reading about supply and demand of crude and oil, when you're watching weather to correlate to, commodity prices, when you're doing all this stuff and you're doing it for love, if you have an emotional response to a chart, you're like, wow, look at that. You're well on your way. Then you trade with very low leverage and you trade very, very conservatively. I mean, you can have whatever leverage you want. A very, 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 very small lot size relative to your account size. And then just produce a small but consistent return with very, very low volatility. And I mean, if you could produce 2% a month after month after month in all market conditions for 2 or 3 years, then you're performing at the highest level as a professional currency trader as registered by Barclays Hedge data on commodity trading advisors in the United States. So let me say that again. If you're a professional Forex trader in the United States and you're CTA registered with Barclays Hedge and you produce 2% a month, you're a freaking rock star. And a lot of you guys are like, oh my God, I could blow that out of the water. Then do it. Because then you'll find if you only have, a couple of grand in your account, 2% a month is like, what, 2 pennies? I don't know. It's nothing. You're like, I can't live on those apples, Wayne. Well, then do it for a couple of years, produce a track record of success, and then start a fund, raise a bunch of money, be an opium trader, other people's money, OPM, right? And now do 2% with $5 million under management. Now you probably have enough money to live. And then you'll do that for 2 or 3 more years, and then your client's going to talk to his or her buddies and say, hey, you should really try out my Forex guy. He's great. So all of a sudden, boom, now you got 15 or 20 under management, and that's when you drive around in your yellow Lamborghini. Right? You understand? It's the get rich slow scheme. It's blood, sweat, and tears for years. It's being wicked smart and wicked tough. That's how you do it. James, I am not going to look at Aussie dollar because I'm bearish on both. What's up, David? Okay. So anyways, I'm going to let the market show me direction here. Okay. Okay. Up, 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 up. I don't know what the number is. It doesn't even matter to me what the number is in this trade. If the market takes it north, we take it north. But we don't buy high. We want to buy low. So we're waiting for a retracement. By the way, this is all published at FX Street. Hey, Dan, what's going on, buddy? How's my Lira trade? I got knocked out a few hours ago. I believe my peso trades are still running from yesterday. But thank you. We can go in those later. So anyways, these strategies are posted on FX Street already. There's 2 things. There's a high volatility event-driven strategy, which I'm going over now. And then there's the counter trend trade off of the support or resistance. Okay, so it's all been published. I did that, published it I don't know, 4 years ago. It's there, so none of this is a secret. It might be a secret to you, but I've published it, right? So anyways, in this high volatility event-driven strategy, we're simply going to scalp this in the direction of the volatility. What? So if the market instantly responded up, we want to buy it, but we don't want to buy high. We need to wait for a pullback. This can happen on a 1-minute chart, then it'll probably happen on a 5-minute chart, and then it'll probably happen on more like either a 15-minute or an hour. Okay? Until we hit that long-term support or resistance, and then you're going to get the counter trend trade. Okay? So in this case, it came down a little further than I would have liked, but definitely held its support, definitely held its support, definitely held its support. So somewhere in here you'd go long. Typically in 3 or 4 or 5 minutes, the market should have moved up high enough for you to move your stop to break even, because the risk here is it goes back up, and this top that originally rejected price, what if that is the counter trend trade? What if it hits this again, double tops, and then drops and falls for the next 2 hours? Could happen, does happen, has happened in the past. So what you want to do is at least move your stop to break even when you get to the resistance line, the line in the sand. If it breaks, you get paid. If it collapses, you had the opportunity and you lost nothing, which in of itself is a big win. And then, of course, in this situation, it broke and you made money. Just a scalp. Other than that, get over it. Then the next thing, the counter trend trade is, let's say we broke 149. Maybe this goes up to a pivot point near 149.50 and then rolls over and dies. That would be the counter trend trade. Thank you, moderator, for posting my model. I think it's called How to Prepare for and Trade Non-Farm Payrolls. I wrote this 4 years ago. How to build a model so that you can, like someone said earlier, have a guess on what the headline non-farm payrolls number is. Because I think a lot of people are obsessed by that. Like I actually showed you, it doesn't actually really matter if you're a macro. But remember, there's 2 types of macro. And this is going to be part of my PhD thesis. There's a long run macro, which is that trend line that you saw in NFP. Let's just call that productivity or production or whatever, output for the economy. It's jobs and wages, but let's just pretend that's GDP, okay? On the long run, and like decades, it should be fairly smooth. Yes, okay, right? It should be fairly smooth, but the country of the United States of America will have a certain amount of labor, a certain amount of capital, a certain amount of technology. They don't really change that quickly, so they're basically fixed. And if you smooth out all the booms and busts, you'll have maximum output. Factories will not be idle. Workers will have jobs, and we will be producing at the maximum long-run output, right? But we know on more of the shorter term, we have business cycles. So there are times when some of the factories are a little bit idle, let's say working at 70% capacity and utilization, which we track, right? You track factory, right? Industrial production utilization. You track that, right? Well, what if it's at 70? And there are other times when it's going to be red hot. Factories are 24 hours a day, that kind of stuff. And then we also know there's times of unemployment and right, and then natural rates, and then even unnatural levels of employment. So these things can ebb and flow over business cycles. But if we're not talking years, we're talking decades, then that all kind of gets summed out to what, or let's say even just academically, you could draw, like, even though it ebb and flows, there's going to be a line through the middle that says this is where the country should be producing at natural rates of employment and capital, right? That kind of stuff, right? And technology. But technology can change, and then output can grow, and then that can, right? All that kind of stuff. But this idea that if you add more workers, generally you get more output. If you add more capital, generally you get more output. How much? Diminishing returns? Sure, but then technology takes that out, and you'll still have this long-run potential, okay? So I'm looking at it from the long macro view of potential. We're at full employment, baby. Who really cares about non-farm payrolls? Well, now what we're looking at is wages and productivity. because we might start to see higher wages and diminishing returns. Right? And so maybe the PhD would be, how do you line up, year over year productivity with long run potential productivity or income or whatever. Does that make sense? But the interesting thing is, if you break this down into smaller chunks, bite-sized pieces, like, we could talk about like income and inequality and stuff, poor people and rich people. You can go all the way back to Karl Marx, which was, when did he write? 1700s? When was Karl Marx? 1780? No, 18. When was Karl Marx? 1817? Or is it older than that? Anyways, so even then he was looking at capital and labor, right? And he could run his calculations and all that kind of stuff. And the interesting thing is, if you look at the share of labor, which are workers, how much of the pie do they have? And then what's left over is, people that own the factories and the buildings and the skyscrapers and the apartment buildings, all that kind of stuff. They earn money off rent. Basically, you rent their capital. You rent their infrastructure, right? You rent their money, if you will. If you need a loan, you go to a bank. But where's the bank get the money? From a rich dude that has money parked there, right? So that's basically rent on their capital in the form of financial capital or actual buildings. You're paying rent to the landlord, that kind of stuff. You can go all the way back to Karl Marx, and you can go back to this year, and it basically hasn't changed. 66% of everything is still owned by labor, income, right? And then the other 33% basically goes to everybody else. 1818, thank you, sorry. Okay, all right on, Dan, that's funny. So anyways, it's just very interesting that the share hasn't even changed that much. Now with the whole 1% argument, well, there's statistical noise happening at that level, which may change the pie a little, but not enough time has happened where that can just shift back. But generally speaking, it's still the same, because it's not the top 1% that really matters. It's the top 33 versus the lower 66, and that's basically the same as it's always been for hundreds of years. Interesting, right? So let's pull up euro dollar. Suppose I'm a bear on the euro, I'm a bull. No, I'm a bull on the euro, I'm a bear on the dollar. But this is pretty elevated, so on and so forth. You've got to be careful.
Plus basis points is up more than nearly 1.5 basis points on the day, and the 2-10-year spread,
in the background.
The long bond down on the day, so the spread to the long end of the curve steepening even faster here as we head into the jobs report. The DAX is down 1.33%. U.S. futures are pointing to a lower open of 0.5%. The S&P minis in the 1/3% in the NASDAQ 100 futures, and the VIX is up about 7.5 to 8%, around 1450.
Oh, funny. This should be
the dollar index up 15 cents on the day, still within 45 cents or so of the recent 3-year lows, though, for the dollar index.
Seconds to our data. Change in non-farm payrolls for January expected to 180,000, 180,000. Priors 148,000. Private payrolls expected 181,000. Manufacturing payrolls expected at 20,000. Unemployment rate seen at 4.1%. That will be in line with the prior month. Average hourly earnings expected at 0.2%. Month-on-month 2.6% year-over-year. Weekly hours expected to remain at 34.5. 5 minute now to the non-farm payroll data, expected 180,000, unemployment expected to remain at 4.1%.
Den says overbought levels.
Chevron earnings at the bottom
If you're in a long run fundamental trend, you're going to find yourself overbought a lot because everybody's buying it. What you're more interested in is when it's oversold in that uptrend, then you can probably buy it. So what do you think? $1.47?
200,000 for non-farm payrolls, 200,000 above the 180 expected. Prior priced higher, 260,000 from
That's going to raise interest rates.
48,000 prior. Unemployment in line at 4.1%. Private payrolls 196,000 above the 181,000 expected, with the prior revised up by 20,000. Manufacturing payrolls at 15,000 is 5,000 lower than expected. The back month revised a little bit lower. Average hourly earnings at 0.3% is 1/10 higher than expected, and the back month revised up 1/10 further to 0.4%. Hourly earnings year over year at 2.9% is 3/10 higher than expected on a year over year basis, with the back month revised up 2/10 to 2.7%. Weekly hours at 34.3, dropping 2/10 from the prior, at below the 34.5 expected. Labor force participation remaining at 62.7%.
Markets reacting swiftly to the average hourly earnings beat and back month revision. The dollar firming, the U.S. 10-year yield above 280 now, 2.816%. Gold futures making a move lower, down about $4.5 at 1343, as the average hourly earnings number handily beats by 3/10 and the back month revised higher by 2/10.
You gonna try it or what? Oh wow. It was a bit slow.
Chevron reported their fourth quarter results in the last minute. $1.64 beats the 129 consensus revenue, about in line with expectation for Chevron.
And Fed. December 2018 Fed Fund future now falling about 1.5 ticks on the day. Following the hotter than expected wage number. The euro yen up 0.5%, 137.42. The dollar yen trading higher by 85 pips at 110.24. The euro falling to a low of 124.64. About a tick off the lows now in the euro as the dollar firms.
Just moving. So I got in late.
Equity markets, we've seen continued weakness across the board as rates have moved higher.
Right. So I tried to click here, and then I just was doing too many things. But I'm at what, 24.80, so I'm up about 25 pips profit, something like that. So I'm up enough where I'll move to the break even. So I can't lose money. So it's just moving along. Yeah, 200, great. What was expected, $1.80, but it's really, as you already know, or as it should know, is the hours and the wages. So this 618 is supposed to produce a 1382, and we're on the 1382. Sometimes when I'm scalping, I like to see the ask. Especially if I'm short. Okay, time to look around the world. Dollar strong against the pound. Dollar strong against the euro. Look at that. Look at me short right here. Look at that. Killing it. Killing me softly with his song. Dollar beating the CAD. Dollar beating the Turkish lira. Dollar beating gold. Oil coming down because the dollar buys more oil now than it did 10 minutes ago. So I think I'm up. Yeah, I need to be careful the next level of resistance. Look at the arrow. By the way, if you're a client to Trader's Way, let me mention this again. If you're a client to Trader's Way, even a demo account, every morning you can trade with me for about an hour and a half. We go through technical and fundamental analysis. Look what I drew yesterday. Double top, drop. That was yesterday. We'll look at it now. That might have been Wednesday. So let's go look at the yen-yens. So again, the concern here is Jay Powell wants to jack up interest rates quickly. It's not that they're going up, it's that they're going up quickly. I don't know if that's true, but now yen is weak against the euro. Yen is weak versus the dollar. Right? Aussie and yen are both weak. Pound yen, moderate, but still generally up, generally up. So Aussie is the weakest. So if someone wanted to look at Aussie dollar, which is probably getting crushed right now, so kudos to that person. But the reason I didn't want to look at it is a longer run fundamentally still bearish on the US dollar. Okay, and now we're looking at weekly pivots. You're at a take profit zone. This green zone here is where you're supposed to, if you're in normal market conditions, which we may not be, and if you're conservative, which you may not be, this is a place where you're supposed to take profit if you're a bear. Now, the interesting thing about being a bear on this pair is that's the sell zone for pivot points. That's where you would have sold it on Monday if you were a bear. There's no other place, really. I guess the breakout pullback is the next one. But in those scenarios, I still just want to ignore. Find other trades I feel more comfortable with. But that's interesting, right? Even the breakout pullback sell, and then this is the target. So you're supposed to be getting out of that short. Yeah. But so even though the dollar's strong, I don't expect it to stay strong, just so you know that. So I'm in the peso, and I lost a lot of ground overnight. I sold here, and look at this. It's come all the way back. Now, I was going to move stops here last night, but I wanted to discuss it with the group on Monday, so either I get knocked out or I stay in. Really, it came down to non-farm payrolls. Well, non-farm payrolls happen to be the glitch in the matrix that produced the bullishness here. So, but the story to this is we knew a week or two in advance that on this particular day, let me try to go to a smaller time frame. We knew at this particular time that we would be selling this pair. So I did it. I sold here and here, and it dropped very significantly, as we knew it would. What you don't know is, you know, again, when it wimps out. In this case, it's wimped out, and we got a non-farm payrolls that kind of went against this. But I think the money could have been taken off the table. This was non-webinar hours, so I kind of want to keep it just to do it during webinar hours. But again, this was predicted in the future. This did happen, and I was sitting on profit. Okay. So this is unfortunate in that situation, but I could have taken the profit earlier. Here's a different view of the same thing with just less lines. So hopefully this rolls over at the central pivot anyways. Well, Lester, that could happen in February. It could happen in March. It's your job as a technician, not as a fundamental strategist, but as a technician, to identify when it's kicked in. What do you think? I suppose you could even argue this was the better trade, sort of in this time frame. Oops. Okay. That's the second last day of the month. Cool. Yeah, no problem, Lester. So if I get lucky, it'll flip over. So like this. Okay. I might get lucky, might not. Can't lose money. And I've collected a bit in interest, so all that kind of stuff shouldn't matter too much. Turkish lira has been very friendly lately. That's a big bounce though, bro. Okay. It's not I mean, I guess you can count that as a monthly pivot. If that held, that predicts a big run in US dollar. I'm still not quite ready for that. So again, I'm hoping that dollar comes up and dollar weakens again. I'm still at that point where, like, technically it still hasn't even fully reversed. So dollar is strong right now. There's no doubt about it. NFP could keep it strong. It could be a turning point. It could, it may, it hasn't yet. But if we find ourselves up here, that'll be a whole different story. But right now, right, it still has a propensity to want to fall. Okay, if we're above this line, then I'm going to say, all right, dollar strong, and that's that. I'm like, okay. And then, even then, I might still want to bust above here. We trade in a beautiful world. Yes, we do. And if you listen to Coldplay enough, you'd go crazy, huh? Just kind of zipping around. All right, we've looked at all that. Fine. Yada, yada, yada. Let's take a look at some commodities. Let's go more specific on gold and oil. Okay. This looks like it's setting up as a 1, 2, 3. 50%. So that should get us down to this point. And then I think we run the risk, if dollar wants to continue strong, we'll run the risk of it doing this next week. Nobody knows. Wow, look at my head on fire. Ah! Ah! Wait, let me shut the window. So dollar continuing to be strong here. Did you guys get the second chance? How many people took the second chance? Remember I said it happened on a 1 minute and then I said it would happen again on a 5 minute? Did anybody get it? On like euro dollar or something else? Let's move back to euro dollar. See it? So you have this move, and then you have that move. So it came down, made a 3A2, you had your second chance right there. Good job! Boom! So I could lock in a little profit here now and call that the high, but like, what is that, 2 pips profit? Whoa, whoa, 2 pips, slow down. Pull back on those reins, bro. So I don't want to make 2 pips profit. It's too pathetic. I just can't do it. So I'm going to go back to break even. Man's got it. Good job. So you're in about what, 124.70? About 20 pips profit. Good job, bro. Good job. So that 382 now predicts a 1618, and oh, we already have that line highlighted. Remarkable, huh? Amazing, right? See? It's this line here. Amazing that this 382, so let me do it this way. Let me redraw this now. This coming up to the 3A2 predicts a 1618. So we'll see if we're so lucky. Ken says $1.23 possible. I don't know. When was the last time non-farm payrolls moved the market that much? It's been like years, isn't it? Isn't it, Ken? And then you might want to look at weekly pivots and monthly pivots. And these are weeklies, aren't they? I changed them, didn't I? Yeah, it's weekly. $1.23. So you're playing a psych level and stuff. I don't even see that as a key level. If you said 123.16 and a half, I'm saying, yeah, maybe. But I don't see that even, the pivots don't suggest that. It's not even a weekly play. What do I change this to, a day or something? Okay, so you're playing M3 to M1, and no, see that even that says 23.77. So I don't know how you came up with 23. I mean, what arbitrary psychological level? I mean, this is not going to go below 23.33 today, at best. Yeah, so I don't know how you came up, Ken. Carlitos says 22.75 early next week. Well, then you got to you're going to go off something else than a daily for that. So we need to go weekly. Oops. And then let me bust this out. So next week our low is going to be, is that 22 or 23? 22.40. 22.50. And what did you say? 22.75 being the conservative target. No, that says 23. So I mean, if you're playing next week's low today, yeah, 23 to 22.50, but you're saying today, Ken. So I don't know how you came up with that. Unless it's an opinion. See, I don't have opinions. I only read the charts. Oh man, I'm killing it now. Up like what, 50 pips? Yeah, killing it softly. Not 23 exact, but 23 something. Yeah, but how did you come up with that for today? I don't see it today. Just like maybe the low of next week, right? But today, no. Tuesday or Wednesday, if this continued, maybe, but I don't know your methodology. So, visit tradersway.com, open a demo account or a live account, and you can trade with me every single day as a client. For an hour and a half a day, 5 days a week, we go through the charts, we do technical analysis, fundamental analysis, but since we do it every day, we have time to cover things like trader psychology and all that kind of stuff. I really hope to see you on Monday at my Monday morning webinar. There's a button in your back office that says webinars. So once you log in, you just click on that button and you're good to go. Hot to go, HOTTOGO. So we're at the 1382, and I'm going for the 1618. So I guess I'll throw a limit on there just for fun. Remember, my stop has to be above it because price has to go through it and the ask has to take me out, which means the bid has to be at or slightly below the target. So just always remember that when you're short selling. So Ray's going to join me on Monday. Cool, Ray. That's funny, huh? Cool, Ray. I think that's the name of an air conditioning company. Cool, Ray. Nine o'clock. Whoop, whoop. Anybody else going to join me on Monday besides Ray? Come on, Bubba. Remember, I thought my entry was piss poor, too. I should have been up about 6 pips higher. I was just doing all this stuff for you guys. So close, but so far, as you two would say. Henley is always here. Yeah, James. I'm going to just take my profit. I don't want to stare at it anymore. See, I'm doing it with my phone. Ah. I can't do a webinar and trade. Eddie says it followed me here. Eddie's like, I wouldn't even be here about that. Cool. Jackie says, looking forward to Monday. Me too. Norwegian. Norwich 123. Yeah, right on. Does that mean you're Norwegian? He's like, I'm not worried. I'm Swedish. Ozzy, Oscar Mike, I'm going to go the other way. Okay, so we want to zip. All right, let's zip. Ozzy, huh? So again, these setups are weird. Okay, if you, oh, that's pound. Okay, if you're bullish on Aussie and bearish on pound, you would sell here, and your target would be $1.73. Where are we now? $1.78. 500 pip drop. And you really think Aussie is going to crush the pound? Gee whiz, I find that hard to believe. But that's what the chart tells me if you're a bear on that pair. I just don't know if I'm ready for that. You just missed my target, I thought. No, maybe not. You think it's going to do it? Come on, Baba. Hey, Mickey. Right on, Mickey's going to join us Monday. Eddie picked up 40 pips on the Aussie dollar. Good job, man. I think I'm going to hit 40 or 50 on this one as well. Okay. Look at CAD, huh? See, these are dangerous counter trends. I just don't want that. I don't care. Now, if I was a bear on this, this would be the sell zone. This would be the sell zone. I have it pre-marked and everything. With the drawing tool, I mean, this is danger zone. And in fact, if I was going to sell USD CAD, the target is 122.30 or 122.00. So this is what it tells me. If I wanted to dump this, that's what's going to happen next week. What do you think? Is it going to flip, guys? Is this dollar strength just any second going to go away? Is this the last hurrah for the dollar? This would be the counter trend trade in my model that that's on FX Street. This would be where you'd be thinking about it, right? This is where you'd smell it. You're like, I smell a reversal. Well, if you smell a reversal, you still need the technical entry, but I'm telling you, this is it. Huh? This would be it. If it were going to, this would be the place. So I dropped into a 1 minute. Gold moving nicely too. It just comes down to like what you trade, right? What your flavor is. So one of the things we talked about, I think it would have been about Wednesday, if you were going to sell oil, there's this one and this one are the two primaries. So I don't know, nobody knows what's going to happen, but if you're a bear, you do know the prices in which other bears would be. You do know prices in which you should consider selling. And these are all pre-marked. So if you were going to trade the lower low, lower high scenario, this would be the first opportunity. And the second one would obviously be the double top, if you want to call that a double top, right? And that just brings you down here. But that could be a longer term retracement back into something like that, or to the 55 EMA in the future. I don't know if you think this is going to drop back to 60. But if it failed to make a higher here, it's an important technically important level to collapse on. Okay. Boy, it'd be amazing if that happened. It'd be super bad for CAD. Look at pound dollar too. Same thing. This, you see this, what I've drawn here? We drew this last week, and it's based on a move that could do that, but that's dollar strength, pound weakness. Like, wow, are we really going to do that this week? No, wait, that's monthly. Hang on, let me change this up. So, sorry, next week would be... ooh, that's interesting. That means on a weekly basis, we would go from here to here, and then that would have to set us up for here 2 weeks from now, and then on our way down to here 3 weeks from now. Wow, that's a lot more dollar strength than I was expecting. Answering Brooke's question, I would consider that profit taking. New lower low. Lock in some more profit. So I have 30 pips profit locked in on the scalp. Good job, everybody. Well played, sir. Well played. If this heads down, then I think that's more like 50 pips. So worst case scenario, 30 pips. Best case scenario, 50 pips. Yup, yup. I'm just going to take it. split the difference. Who cares? So 35 pips. Or 40. Might have been 40. Can you guys hear the Metallica in the background? Might be a little loud. I'll turn it down. Cool. Now what? Yeah. Battle Ray! No double-edged spikes on this, huh? Euro yen moving, pound yen not. Maybe they're different time frames. 30 daily. Yeah, there you go. Look at this big move here. One of the things we talked about in the recent webinar for Traders Way clients, this goes back to last week. The projected high for this is like way up here. Now remember, I have been bullish on euro. I was hoping for more yen strength, but it just didn't open that way. And I keep teaching that it comes down to not what the charts say, but it comes down to what your analysis is. In particular, your fundamental analysis of macroeconomics and central banking policies, and the difference between these policies amongst central banks. You could have woken up that morning and been a bull in this pair. There's no doubt about it. And if you were, that's the absolute perfect entry for monthly swings. Yeah, so Lester, I am bearish. Well, not on euro yen. I've said specifically not euro yen. But I was hoping to see Japanese yen strength. Now, we got some of that in many of the currencies. So, like, for example, what we did get is I predicted that December would rally. The first Monday of January, right after non-farm payrolls, would collapse. Then I predicted a false rally. And then a decline. So I got this one right, this one right, this one right, and this one half right. The rest, you know, and the funny thing is I predicted this 6 months ago. To the day I'm predicting these moves and to the day they're happening. So this part didn't predict, only got it half right. So what does it mean? Well, it means euro's pretty strong. I mean, it's very strong. Now you look at this on a different currency pair, Beast, and do that. I guess we got to do 4 hour. Here's the December rally. Here's the Monday after non-farm payrolls decline, and then the false rally, all of which were predicted, and then it didn't come down. So I got this one right, this one right, this one right, and that's that. All right. So there's two, a lot right, but a little bit wrong, okay? Here's the December rally. Here's the mutual fund Monday decline. Here's the false rally. Remember, I'm calling these like third week, first Monday after non-farm payrolls. I'm calling these out 6 months in advance to the day on particular weeks. And then from here, the false rally should create a downward trend. Now, I'm hoping for bigger Japanese yen strength, but I haven't quite got this one either, but it certainly isn't wrong like the other ones. So obviously, Aussie's weaker than those other two currencies. But, you know, I'm not bad, right? And if you go back to the FX Street interview I did in 2016, I predicted almost exactly the same thing, and it did happen. And I did that in that 1 hour interview. I was sitting on the slopes of a volcano. Actually, I was at the Four Seasons, a suite at the Four Seasons. Actually, a villa. I was at a villa in the Four Seasons with a golf course and a volcano behind me. But I'm also wearing a three-piece suit in a 1 hour interview with FX Street. And I went through how I had shorted all the Japanese yen, right, which means I'm long all the Japanese yen pairs. And I was about to dump that whole position. And then around the third week of January, there'd be a false rally. Same thing here. Up, down, up. So I did it in 2016. Well, I guess it's the open of 2017. And in I think it was December 12th, 2016, I'm telling you I'm about to do it. Okay? So now what do I do? Comment on, like, why hasn't the euro-yen fallen? Well, euro is unbelievably strong, and you should know that. Pound it was so oversold over the craziness of Brexit that it's just reverting to the mean. Some of the other commodity currencies have behaved a little more predictably, I would suppose. Right? Here's Kiwi. I got this all drawn up, but something similar going on here. December rally. First week retracement. Third week rally. And from there, down. That actually made a lower low. I mean, that's not bad. 6 months in advance. Right? I don't get any love for that. 6 months in advance telling you to the day which direction the yen pairs are going. Remember, everybody knows it's unpredictable. You can't predict the markets. It's unpredictable. Well, I have theories, and then I test the theories using technical analysis, right? Well, yeah, Lester says Aussie's fundamentally weak because of the RBA. Yeah, well, and the RBA sets that up based on economic data. But here's the interesting thing. They're an exporter. They actually want a weak currency. So who said it was such a bad thing? Japan wants a weak currency. Australia wants a weak currency. China wants a weak currency. Right? And I would say the United States wants a weak currency. Sorry about the drumming. This music's awesome. You gotta love Metallica. All right. All right, so what is the time? It's time to get ill. We have the stock market going to open soon. How do you think the stock market's going to react to this? It's just the part of the song you just have to drum. Master! Master! No, it's not a battle of weakness. They're just exporting economies. So they're not battling each other. It's just normal economics. Swissy killing the Aussie, Swissy killing the Kiwi, Swissy trying to turn the pound over, and Euro stronger than even Swissy. See, here's the thing. I don't know if you don't get it. So this is stuff we do talk about at the webinars every morning if you're a Trader's Way client. One of the things that's happening is the United States economy is actually quite robust. It's already quite good. Stock market's at an all-time high. Real estate's up. You know, bonds are collapsing. So basically everything that's been bought has already been bought. And all the valuations are high. I mean, it's sort of it's done. Where were you 10 years ago? Like you're trying to buy the stock market now? Really? What the hell's wrong with you, right? 10 years late. Now you want to buy in? Right? Doesn't sound smart to me. So what smart money is doing is they found the Euro economy, the Eurozone economy, troughing out of the recession, which means the bottom's been printed. It's not going to get worse than it used to be when Spain was on the brink of collapse, France was in trouble, you know, Italy and Ireland were bankrupt, Portugal was bankrupt, Greece was bankrupt. We're not in that world anymore, so you don't face those same risks. And now that you got all your money deployed in the United States, you're like, well, when I got my fresh money, so let's say you rebalance your portfolio and you take some dry powder out of your Apple stocks and your Facebook stocks and stuff. What do you do with that new money? You can't just buy more, right? So what you do, you're like, I'm going to start buying European companies because they're cheaper. They're just cheaper. And that's why the currency is going up. At first, if you go back 2 years ago, when Europe was still in a heap of trouble, the euro started gaining strength. But I can prove to you that that wasn't people buying euro. It was people getting out of their euro dollar shorts. It was the beginning of the dollar weakness move based on tapering out of quantitative easing. So if you're getting out of quantitative easing, well, when you were in quantitative easing, you were buying US dollars so that you could buy treasuries so that you could front run the Fed. It was just like free money. Well, now that that's over, you had to get out of your position. And if you were long dollar, you were short something and you were probably short euro. So we went through like 6-month period after the taper where the euro was strong, but nobody was actually buying euro. They were just exiting euro shorts, and I can prove that to you. But then when that was done, the euro continued because once people had the cash, they were getting out of these bond positions. Then they turned around and said, well, what can I do with this cash? I don't want to buy the stock market at an all-time high. So then they're like, well, why don't I go buy Europe? Yeah, it's not a great situation there, but the worst is over, and I can buy stuff cheap, which is a value play, which compensates me for the risk that I'm taking, but it's less risk than it used to be. And that's what you ended up doing. And then from there, the euro gets stronger because people are buying the euro. Does that make sense? Now, this is business logic. You will not hear this from a professor at a prestigious university. You won't read it in a textbook. They'll simply tell you the Fed's paying a lot more interest than the Eurozone. The Eurozone's actually negative interest. The Fed is paying 200 basis points more, and they're raising. So the dollar should be ripper strong, and the euro should be weak. That's what you'll learn in college. And of course, like most things in college, it's completely wrong. So you just got to listen to Uncle Wayne. It's a business issue. But on the long run, they're probably right. But in the short run, because they're not macroeconomic professors, are not tracking like, oh, that's statistical noise. No, 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 no. That's the market today and tomorrow and next week. It's not statistical noise. It's how I put food on the table, right? So you have to take short run and long run. And then I, as a business person, I take short run as business cycles, which my short run is still years, where academia is more like decades. But therein lies my PhD. How many people at Harvard or MIT or Princeton or Yale have written a PhD thesis on economics, but they happen to be wicked awesome traders in the real world? Probably like none, right? So it'd be interesting to go in from that point of view, like, okay, I know the real world first. That's where I learned stuff. And then I went to university and learned the academic other stuff. And let me tell you, the calculus on proving the macroeconomic stuff that I know to be true, the calculus is like, holy crap, way out there, crazy stuff. And I'm like, yeah, well, you know, I understand your calculus on the supply and demand of loanable funds market data, but I can just tell you, if it's more expensive to borrow money, there's going to be less borrowing. Why do we need the calculus, right? But anyways, it'd be interesting to go in as a real worldist first, then learn the academia on top, and always be judging the academic logic with your real world experience. Because I'm 40,000 years old, right? I'm 44 or something. So I'm coming in from a different point of view than a typical 25-year-old that's never been in the real world, never traded for 15 years first in the real world, and then learn the academic stuff. They just learn the academic stuff, and they're like, yeah, my really smart professor told me if interest rates are going up at the Fed and they're negative in Europe, that the US dollar will be ripper strong. And they'll regurgitate that crap forever, until the ivy quits growing. For me, I'm like, no, that's not actually true. But I understand the logic, but you're thinking long run, and I'm in short run, and there must be a unified theory of macroeconomics, right? I just have to figure it out. So what are you going to do with your free time? That's what I'm going to do with my free time. But I got to bang out this graduate degree first, huh? So stock market's opening any second now. You think we'll get a move here? Looks like I was a smarty pants for getting out, huh? Took my profit, was it here? Yeah, what a smarty pants. What was it? I have to shift.
15
right?
seconds.
Yeah, cool. It's not a band though. I'm trying to grab this thing. Anyways, you can see I entered here and I exited here. How did I do? I exited right there. I can't grab it. I'd like to make it fat. Is it trend line? I guess so. There we go. How did I do? Shorted here, exited here. Yeah, there's a lot of counter trends setting up now. And that could have been an entry for somebody else, right? The interesting thing is some of these counter trends could last like a week or so, or forever. But here's our counter trend on the USD CAD setup. Remember this? We're just talking about it. See the role reversal, central pivot, and everything. Okay. You've even had the second chance role reversal entry. Pretty nice, right? Yeah, thanks, Anise. Yeah, the entry and exit should have been better. The exit was fine. The entry was actually slow, but I was doing stuff for you guys.
Steve Villeroy saying that whether ECB ends the QE program in September is not a key issue.
So we have 1 hour left. This is where we go to open mic, where you can ask questions. Nice. You just dumped your ON to FXCM accounts and joined it Trader's Way? Good job.
Or saying that they'll monitor impacts on the exchange rate evolution.
So I'll see you Monday.
Remains a source of uncertainty. ECB remains ready
What's your
to
real first name
reassess
so I
if
can say hi to
necessary.
you on Monday?
There shouldn't be excessive focus on the instrument of monthly net asset purchases.
Hey, by the way, don't we have durable goods at 10 o'clock? So we got that we can trade. We can take a look at, see my peso trades. Okay, that's lira. Let's kill this. This is another situation where I told people weeks in advance the day which I would consider selling this pair. And I did it on the day I said I would. And it came down here. And then it kind of failed on me. So we'll see if we can get this to recycle its way back down. But you see, I got one stop here. And I have one stop here now. So I have two slightly profitable trades. And we'll see if the US dollar weakness continues from here. And we get a peso move. Okay? So there's a video on YouTube where I teach you why this works and how to do it. I think it's called How to Trade the Mexican Peso and Why It Works. Pretty, so you can Google that on YouTube. Yeah, you'll have to Google it. So yeah, don't let me forget we have durable goods coming up. Shall the dollar weaken in the upcoming week? Well, that's what we're trying to figure, right, Adam? All right, so I'll see you, Kyle. I'll see you on Monday. Well, Den says, was getting registered as a CTA worth it? Yeah, at the time it definitely was. It's required first and foremost if you're going to run a managed program in the United States. The problem is regulation has gotten pretty high and very expensive. If you've noticed, brokers in the United States have been essentially pushed out, right? You know, I mean, I remember there was a time, I can't remember how long ago, 10 years ago or something, I was hanging out at FXCM in their offices in downtown New York, and met Drew Niv, and just I was doing some relationship building there. Anyways, so I was meeting the senior staff, met some of the other people, and was getting a tour, right? And then they said, and in this room, and the room was filled with, I don't know, like 30 employees. They're like, this is our compliance staff. I'm like, what? Like, it was huge. It was like a customer service department. And it was so expensive for them to run that, like impossibly expensive. And, you know, eventually they got in some trouble with the Swiss National Bank, and they did some kind of not so good things, I think, and they got in some financial troubles, and they just couldn't run their compliance department, I guess. I mean, I don't know why they left, but they left the United States. But GFT left. I worked for years with GFT. Remember Interbank FX? Remember them? I used to do presentations in their booth at Forex expos and stuff, and just, you know, yeah, 2008 I was an education partner with FXM. Yeah. So anyway, it's just not something that's done very often anymore, unless you're a very big firm with lots of employees. And I mean, as a currency trader now, I don't know if you want to be a CTA, because imagine spending, let's say you spent $100,000 US a year just in compliance. Okay, how much money under management do you think you need to afford that? Because first of all, you only get paid off of the profits, and then your basic, just minimum bills are going to be the compliance stuff, which, you know, I had monthly reports, I had quarterly reports, I had annual reports, I had outside third-party audits, I had regular compliance audits. You know, and then you have to do things like every little change you have to make has to be triple signed, and disclosure documents have to be written by lawyers, and history has to be done by lawyers. I mean, just like, it's a minimum, maybe 200,000, even if you're a one-man shop like I was. So, was it worth it at the time? Hell yeah, because it was really, really good for my clients to be protected by the rules and regulations of the NFA that were there to protect them. I mean, it was a good thing. And then maybe it just got, after the financial crisis, maybe things got a little weird where the industry went from under-regulated to over-regulated, and then, you know, and all that kind of stuff. So who knows? But to do the right thing for the client is always the right decision, no matter what the cost. The problem is the cost will get so high that, God forbid you go through a rough period and you're not earning money, you're not going to be able to afford compliance, and that's that. So you better have like millions of dollars laying around just for operating expenses, which means you're a pretty decent sized fish. There's no small fish, there's like sharks and there's whales. Or you don't work with US clients, you work offshore, and you have different regulatory compliance costs and such. And it's a whole different ballgame. Okay? Yeah, and he says U.S. regulators banned FXCM. Well, who's to say? But I can tell you, when that happened, I had a friend that had, I think it was $600 million or something crazy at FXCM. I'm like, you have how much at FXCM? Yeah, a few $100 million. I'm like, what? First of all, I'm like, you have that money in a retail Forex account? Really? And then I'm like, you should probably seriously consider, you know, the risks you have when the company is folding in the United States. Maybe they fold other places. I don't know. You should just be careful. And do you remember when Refco went out of business? And that was seriously tied to FXCM. Clients lost money. But whatever. Cool, Anise. So looks like I'm hanging in here by what do they say, the skin on my teeth. That's gross, right? So WTI, counter trend trade, cool, right? There's the counter trend trade. Yeah, hanging on there. Gold. Here's the other, right? That's the other counter trend trade. So, for example, how do you pull the trigger on this? It's only a 1 minute chart or a 5 minute? A 5 minute chart. And if you're going to sell at resistance, you should have a reversal pattern. So what would that include? Well, that could include a 1, 2, 3 or a double top. So you have to ask yourself, if you're a bear and you want this counter trend trade post non-farm payrolls, you need to be at resistance. So do you consider this resistance? Top, 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 plus central pivot. That's the first thing. If you're a bear and you consider this resistance, then what's the second thing? Now, how about some sort of reversal pattern? So what if you get, sorry about that. What if you get something like this? If you got something like that, at what point would you start shorting? Here, 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 here. No, Dan. There's much better ways at that point, depending if you're liquid or not. I think a lot of people that buy real estate, they're not liquid. I mean, they're borrowing the money. if you're liquid 600 million, there's some very, very, very interesting ways that these people make money. And that level is just, it's amazing to me. It's just really amazing. At some point, I'm like, even at that level, it's so easy to make money that it's almost like, wow, you even trade Forex when you're liquid that much? Because you could lend that bank to many other institutions that can do some pretty funky stuff to make you some pretty big money. All right? So nobody buys a skyscraper with 600 million cash, right? You build a consortium of lenders and such, and you essentially buy it with leverage. 600 mil cash, 1 billion in cash. These guys are offered opportunities that shocked me when I just, wow, just incredible. So, you know, you talk about the top 1% getting rich. Wow is the truth of it. Wow. But most people are not that rich, and that's it. You're right. So, like, if I had, like, let's put it this way. If I had 600 million in cash, I wouldn't be buying real estate. I already own real estate stuff. I mean, this is cash. This was liquid money, right? So, in that case, if I had 600 million in cash, I'd be financing humanitarian projects. You know what I mean? You'd be rebuilding countries. So happy I got out of that US dollar short, huh? Woo-hoo-hoo-hoo! You got to know when to hold 'em, know when to fold 'em, know when to walk away, know when to run. Look at the exit. I mean, hoo-ha! Hoo-ha! Scent of a pip. So you can see even on a 15-minute chart, it gave us a 382. Don't be shocked, though, if it does go all the way back to where I entered, which is this orange line, and then makes the next big drop. But yeah, so yeah, what if you were building a hydroelectric dam in Cambodia? There are different rules of engagement, and big, powerful organizations and institutions that would really like you to do it with your money, then like the World Bank have to do it with theirs. And let's say there is an Illuminati. Let's just say that. There is an Illuminati in the world, and that if you're willing to do that, there are blessings. Blessings. But how many people in the world are like, yeah, sure, 600 bill, right? 600 million, even 600 billion is not even really enough. Yeah, if you had 2 billion in cash, yeah, it's really, even 600 million at that point for humanitarian is not quite enough. But yeah, if you had a couple of B's liquid and you were going to help the World Bank build hydroelectric power, you know, in Cambodia, yeah, you're on a whole new level. Buying farming conglomerates, that's just work. Rich people don't work. Or, sorry, wealthy people don't work. So I don't know. Do your own research. So 10 minutes of durable goods. what currency pair do you want to trade in regards to durable goods? I figure you want to do a dollar play, but what, dollar Aussie? Dollar CAD? Yeah, well, Alan, the secret isn't to do it privately. The way that you do it is you help sort of the public institutions do it with your money. So yeah, dollar's trying to get ripper strong going into this news. Wonder if well, we were talking about this earlier, Adam. A weak Aussie dollar is actually good for Australia, so why not? Have you gone to the RBA website and read any of their releases? I mean, they'll tell you straight up what's going on. They're not hitting inflation targets. They're not exporting as much as they would like. I mean, it's straight up weak, and it you know. Not, I wouldn't say much surprise. So like, you look at this, and you're like, wow, but it's been strong for so long. No, that's dollar weakness. So you'd have to look at like an Aussie yen play for that. And it's a lot less hot to go. Okay, here's the December move. Here's the second week collapse, third week false rally, fourth week down. Okay, and you can see we've broken the uptrend. So when you break an uptrend, what you're supposed to do is let it run, let it pull back, and then you sell at the blue line, which we have. So the next step here is down, but I had this planned out in November. Right? Think of that. I had this planned out in November. So if this sucker drops today, wow, unbelievably lucky. So here's the buy-in in December. Here's the predicted retracement. Here's the predicted false rally. And then this should be the breakout, retracement, and down. And that should be the full-on reverse. Right? Cool, right? Don't you just love making money? Boom! 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 Now, if you can translate fundamental plans into technical trades that produce 2% a month, you are, as I said earlier, based on Barclays Hedge reporting of CTAs in the United States that trade currencies or macro or something related, 2% makes you a rock star. So if you can do, as a retail trader, 2 or 3% or 3 or 4% per month, month after month, some months maybe you break even or get 1%, other months you get 5 or 6%, but on the long run, right, your Y bar, if you will, if you could produce, on average, 4 or 5% a month, I mean, we're talking 60% a year, you would have just money flowing to you, as long as there's no volatility. If you have a lot of volatility, which means you're up 12% and then you lose 8%, that kind of stuff the next month, and then you're back up the next month, that's volatility. If you're just slow and steady, steady and slow, 2%, 4%, 1%, 3%, but every month you're never taking risks, you're never loading the boat, you're just doing your job, you're staying patient and disciplined and conservative, and you just have boring results month after month for years and years and years through all different market conditions and cycles, you will have money raining out of the sky for your services. And you will be filthy, stinking rich if that's what you want. Maybe you'd start funding humanitarian projects. Right? I'm working toward a humanitarian project. I'm not going to tell you what it is, but I am. My goal is to win a Nobel Prize before I die. I got to get through Harvard first. But yeah, so start planning your humanitarian project. Your first one should be taking care of yourself, your family, right? Your spouse and your children, and then your loved ones, like your mom and dad, take care of them, and then be an inspiration to your friends and extended family around that. And then one day start giving back. Like I've been doing this now, what, 15 years, doing these webinars every single day for 15 years, sharing everything I know, plus my love and my spirit and my passion and my drive. This is me giving back. And the next step is to a real humanitarian project where I not just change a community of currency traders in a positive way. My next goal is to change in a positive way an entire country. Cool. Right? And my business associates and I actually have received Happy New Year and Christmas blessings from top brass of a country. Right? So when you have a prime minister or a president text you, hey man, Happy New Year, all your best, I hope your dreams come true, and this is from a leader of a country, you're on the right path. And that actually happened. All right, 2.5 minutes, durable goods. Yeah. Which, you know, is a bigger scale. So I've done things like I've gone to slums of India, worked with children, planted trees into the ground. I don't think I changed the children's life. I don't even think that tree is still alive. So maybe money will make a difference. Right? $1 billion here and $1 billion there, pretty soon it adds up, right? Yeah, thank you, Dan. So there's the Aussie, a much different world, right? I think I'm right about durable goods coming up? Maybe we should just trade buck for that. Look at that. That's the continuation off the 382. That's the third chance. Look at the tertiary on that. Sounded dirty, huh? Wow, look at that tertiary on that. Woo! Look at that.
Saying a strong dollar is always in the best interest of the U.S.
Beautiful 382. Boom. 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 Look at that 382. Thank you, Leonardo Fibonacci. Holy smokes, huh? See, the stock market's open now, right?
1 minute now to the top of the hour. We'll get Michigan sentiment reading. January final expected at 95. U.S. factory orders for December expected 1.5%. And with the factory orders, we'll get the December final durable goods orders data.
Holy smokes, huh? Woo-hoo-hoo-hoo!
January University of Michigan final sentiment reading and the December factory orders and durable goods orders data in just a few seconds.
Two subwoofers.
95.7 for Michigan sentiment above the 95 expected. Factory orders 1.7% is 0.2 higher than expected. The back month revised up 0.4 to 1.7%. Durable goods orders at 2.8%, and the final reading is down 1/10 from the preliminary. Michigan current conditions at 110.5, above 109.2 preliminary. Expectations index at 86.3, up from 84.8 preliminary. One-year inflation outlook at 2.7% is 1/10 lower than the preliminary. Five-year inflation outlook in line with preliminary at 2.5%.
Damn, that trader made my day, like the butcher, the baker, the candlestick maker. Nice. That was the first thing I looked at The Wealth of Nations. If you've ever read The Wealth of Nations by Adam Smith, you get to the part on money and currency, and they talk about the butcher, the baker, and the brewer. The butcher, the baker, the candlestick maker. I mean, one of those is Run DMC. One of them is Adam Smith. You have to figure out which one's which. Woohoo! Yeah. So this 382 is supposed to get us down to this 618, right? And that's called the weekly central. But this is also a monthly. So we were talking about this not long ago. These are set up for long-term dollar strength moves. Long-term meaning at least a month. But it was hard to believe because we didn't have technical confirmation, right? Right? So where did we have it? Not here, we had it on the other one. That if this pans out, it's a long way down. I think I have it on this. Hang on, I gotta get rid of this. Yeah, it's in here. I can't even see it because I'm right on it. Yeah, this line here. If this is the top, okay, if that's the top, this is where we're going, folks, with the US dollar. That's what it says. I don't know if that's what's going to happen. But don't be shocked if next non-farm payrolls were down here. And I can't even read that. What is it? I still can't read it. What is that? 1850? 1850? We were just at 25, bro. Is that right? Am I reading that? I mean, I need glasses or something. Is that right? 1850? Wow. It's a lot of pips. But we were talking about this last week. There's nothing technical to say that that's going to happen. And if it happened, it would be down and then up and down. All that kind of stuff on those shorter time frames. But we were set up to do it. And we definitely talked about that a week ago at Trader's Way. So I don't know. Here's the thing. I don't know if it's going down. But if it's going to go down, that's where it would likely start. Now we need the fundamentals to back it up and stuff. But that's what this technical analysis tells me. You know? Yeah, that's 700 pips, right, Dan? 700 pips is what it's telling us. So, again, I don't know if that's right. I don't know if that's going to happen. I don't know the future is any more than you do. But if it were, that would be the line in the sand. So you, as a market participant now, you would use shorter-term technical analysis to short into there and manage your risk of shorting into what was previously an uptrend. But at some point, you'll have to say, if it does fall, did the market reverse? Yes or no? But that's a double top, and then there'd be a lower low. So most likely on the smaller time frame, it would make a lower low, and then it would rally up, and then maybe do something like this, and then from that, it'll do that, and so on and so forth, right? But at some point, you're going to have to make the decision, okay, it's no longer an uptrend. When is it? Well, selling a double top doesn't mean it's reversed, but making a lower low below this high would be a technical reversal. But this is a longer term point of view. When do you make that decision on a smaller time frame? And that's going to be your alpha. Right? When do you make the decision? Wow, am I 44 years old? I'm like a child. Hey, I'm a college student, man. Leave me alone. Isn't that crazy, though, learning macroeconomics from senior economists at the Boston Fed and at the New York Fed? I mean, like, thank you, Harvard. I mean, that's a dream come true. Total dream come true. Like I said, so far, I've understood all the economics. So I'm very happy with that. And then he proves it with calculus, and I don't understand the proof. It's just, I don't know calculus. I just don't. And I'm like, wow. Right? So, right? So he'll do something like the marginal production, production is a function of capital and labor. Understand that. I can do that all day. Then he's like, so you take that and you do this and you do this and this and then you move that over there and you do that and that. And it's simply a derivative of the negative alpha. And I'm like, it's a derivative of the negative alpha? What the hell are you talking about? I get it. You have machines, you have capital, you have technology, you put them together and you're going to have output. Have better technology, more output. Add more workers, more output. What? With a diminishing return. I understand all that. The derivative of the negative alpha? What the are you talking about? I'm like, I'll have to trust you because I have it from a common sense point of view, but oh my gosh. How to take something easy and make it complicated. Welcome to school, huh? Oh. So what do you guys want to do? Ask some questions. We got 20 minutes, bro. YouTubers, come over to the chat. This is a big one, guys. This could be big if it sticks. Amazing. Yeah, the market just doesn't like it because they feel like the Fed is going to, that Powell, remember, it's mostly an unknown. that Powell is going to be more aggressive in jacking up rates. Yeah, 3 hours is a long webinar. But there are turning points here that you got to be careful of, right? I mean, that is a reversal zone for show. Look at this, just gorgeous. Well, you wouldn't take that now with the strong dollar. You got to wait for the weakness, because a weak dollar is positive macroeconomics. And when I trade exotics, it's based on that. And we don't have market conditions for that now. So I did very well yesterday on that, and I wouldn't do it again today. Okay? Not yet, not now. I got to reevaluate Monday, see if the world reevaluates the situation. Maybe they're overdoing it today on the dollar strength. We don't know yet. But like I said, there are some pretty hardcore technical reversals that may have been taking place here, which could mean 3 weeks of dollar strength. It could mean 8 weeks of dollar strength, or it can mean 8 hours of dollar strength. I don't have enough information to make that determination. So I'm sort of a wait and see on that. So I don't want to go on the exotics. This is a dollar play, guys. If you're not playing the dollar, you're just missing the whole point. What the hell? Hypocrite. Yeah, I mean, look at this. This is sick. This tells me we're taking this up here. This is USD CAD. I mean, this could go up for a month. What is this? $1.36? Is it 1,300 pips? I can't read that. Or what is it? 126? 20, 24, 25. Yeah. So 126.20. A couple hundred pips. Yeah, I typically don't trade Euro Aussie, but we can take a look. I mean, obviously it's going up, right? So it's not supposed to go any higher. The amazing thing. Technical analysis tells me that this low predicts an exit up here. Shoot, sorry. Okay, that's the move. So we're done for Euro Aussie, which means if Euro dollar comes down and stays falling, the Euro dollar is going to pull the Euro down. Well, I just got other. It's not that I don't. I said I typically don't. I typically just trade other things. Like if I'm trading Aussie, it's Aussie dollar, Aussie yen, Aussie Swissy. After that, that's just enough Aussie. That's all. Pretty amazing. Right off the top there. Well, what direction is euro dollar moving? Down. So the dollar is weakening the euro. So therefore the euro could weaken against Aussie. But the problem is, in that case, we're neutral on euro Aussie because Aussie is also weak. So euro would suddenly be weak against a weak Aussie, and so nothing would really happen is the other answer with why not look at euro Aussie. It's done. It's dead. It's over. Ish kaputya. That would have played out by now. So even if it moves, there's just probably something better to be doing with your time. That's all. Because look at if dollar weakens the euro, it's going to weaken the Aussie. And I already pointed this out, that this top here predicts a move down there. So euro and Aussie would be both weak relative to the dollar. Now relative to each other, it's a guess. And that's why I wouldn't be interested, because I don't guess. Anything else? Any other requests? Look at CAD yen flipping at the predicted top. So if you're a swing trader, these are all moves. The thing is, you'd have to be a bull. I wasn't a bull last week, so I'm not on this. But you could have been, and that would have been the move. And so now I wonder how far it'll pull back, if it's profit taking or if it's selling. We don't know that yet. 7:30 in the morning New York time. All clients of Traders Way, both live and demo, just go into your back office, and there's a button in the top right-hand corner that says Webinars. You're in, bro. 7:30 a.m. New York time. That's approximately London lunch, and that's 2 hours before the stock market opens in the Big Apple. Beautiful moves here. So let's do next week's pivots on here. Change the template. Yeah, all right, so this says if this continues down, that CAD yen's going to fall to 87.63. Okay, if this continues down, we'll probably keep selling this all next week until about here. If we hit it on Thursday or Friday, we'll take profit. If we hit it on Monday or Tuesday, which Monday doesn't look likely, but Tuesday is possible, then we'll counter trend it back up. Mitch, swing on by. Huh? We'll take care of you, Mitch. Open up that demo account, swing on by Traders Way, and we'll talk about it Monday, get you set up, huh? Yeah, Kurt Worley used to go over correlation over and over and over again. He's now a senior data scientist. Woo-hoo-hoo-hoo! He was just my quant and a good friend. Seniors, data scientist. That sounds like important and stuff. Smart and stuff, huh? Master's degree in applied statistics. Yeah. Master's degree in applied statistics. That could be fascinating. But the math would kill me. I don't recall. And it wouldn't be my place to even say. So, I wonder if this drops like a ton of bricks now. Risk-off sentiment, at least a cooling off period. Could be very interesting, so we don't know. There's just not enough data. The other thing is on Monday, if it bounces at this, oh dang it. If it bounces here on Monday, that could be a buying opportunity. So which one's right? I don't know. But if you were going to play it, you'd play it today, right? And have your stop basically here. And see what happens. And if Monday or Tuesday we break above, then you're just simply out. And you took a shot, took a loss. If you're right, you'd be down here. The opposite is, if you wait till Monday and you're a buyer, you're going to want to buy down here, and your stop's going to be here. Okay? And then hopefully if you're right fairly quickly, and you'd be able to move your stop a little closer. And you should be safe until about this zone. And then whoever, if you sell here or buy here, one of them will work. Again, I'm not really going to watch USD yen because they're both funding pairs. So if the dollar's strong, the yen should probably be strong. If the dollar's weak, the yen should probably be weak. And then there can be a dichotomy between the two, but then I don't want to trade the spread between the relative strength or weakness. So I'll just take that data and I'll simply surmise it down to risk on, risk off, and say, well, I'm either going to sell buy the dollar relative to other pairs, or buy the yen relative to other pairs. But I wouldn't trade the two together, okay? Is it CANS, SC, or CK? CANS, CK? Kansas City? That's funny. Kansas, should be CT. Kansas CT. Three minutes. Okay, yeah, we have done gold, but we can do it again. Sorry, I guess if you came in late, why not ask the last question? You're not bothering anybody, right? So here's our gold. Go out to what, a 1 hour? I have it going down to, what is that? 120. Is that 1325 or 1225? It's 1325. Yeah, it must be 1325 from 1350. So it's predicting a 25 pip drop. Now, longer term, it could, if the dollar continues to be strong, it looks like we could break 13. So trickle down to about 1290. Okay. So I hope to see you Monday at Traders Way for our daily webinar, Monday through Friday, tradersway.com. Open a demo account, open a live account. There's a button in your back office that says live webinars. I'll be there at 7:30 in the morning every day. We have so much time since we meet every day that we can cover anything that you need to succeed. Okay? Thank you to FX Street for hosting us. We appreciate the opportunity. We're getting pretty close to the 12-year anniversary of this monthly webinar. So this was 142. March will be 143. And it seems like April will be the 12-year anniversary of this particular webinar. I've already done 12 years worth of work with FX Street, and I love them. They're good people. They're tall, good-looking, kind-hearted, smart, athletic people. We appreciate them. For everyone else, I hope you throw your diamonds in the sky and become a proud client of tradersway.com. So visit the site. There are bonuses if you want them. Fixed spread if you want to do scalping. Variable spread if you want low spreads. If you don't like spreads at all, we have ECN accounts, all kinds of things. And of course, me working with you every single morning. So peace out. Peace on earth. May the pips be with you. May your profits be above average. Good job today. We made money and we survived. See you on Monday. Cheers.